Hello, Intro to Accounting. Today we're going to jump into Chapter 1, Section 2. And there is a ton of content in here, so we're going to split it up a little bit. And the first thing I want to do is talk to you about some vocab words. Now, yesterday we went directly through the book. Today I'm going to do something a little bit different, and I'm just going to talk about these words. I do expect you to still go into the book and take a look at it yourself. That's kind of part of this class, is make sure that you go in there, you look at this content, and I'm going to give you an overview of those words that we're looking at. So let's just kind of jump into a couple of those things as we get started. The first thing that we're going to look at is a service business. Now, why is a service business going to be important? Well, because that's what Michael Delgado runs. And there's something a little bit different with a service business versus like a merchandising business. One of the biggest things is we don't have physical inventory. So when it comes to the accounting, a service business is going to be different than a merchandising business because we have different accounts. So thinking of a service business, that would be a taxi cab company. If you drove for Uber, that's a service business. Maybe babysitting. All those are service businesses where at the end of the day, you provide a service for somebody. They don't really walk away with a good, like a manufactured good, but you still are providing a service, and that's exactly what Michael Delgado does. So, continuing on, Michael Delgado called himself a proprietor. And what that really means is that you are an individual that owns a business. A lot of times, this is considered a sole proprietorship. So why is that important? Well, it's one person that runs the business. It's not a partnership or anything else. It's very easy to form. Most businesses in the U.S. are a proprietorship. But there's some things that we need to know about being a proprietorship. The first thing is that as a proprietor, you have unlimited liability. Now, we've looked at liabilities, and it's always something that we owe. When we look at unlimited liability, we kind of should probably get nervous because it means that you can owe an unlimited amount, right? So why is that important? Well, if I'm a sole proprietor, what that really means is the business itself and my own personal income are kind of tied together. Now this gets a little bit tricky because we don't record it at the same time. Like we don't record, hey, I purchased a car, I'll put it on the business records. But what it means is let's say your business had a lawsuit against it. You did something you shouldn't have done, and now you're in trouble. Well, what that means is that you and your business are kind of tied together. So if you got sued for $1 million and your business didn't have $1 million, that means that your house could get repossessed. That means that you personally, your savings could get taken away. So it means that there's unlimited liability, meaning that if something bad were to happen, you could be liable for that. You yourself personally. So a proprietorship, sometimes called a sole proprietorship, is really easy to set up, but there's also some negatives that go along with it. So next, we want to talk a little bit about interest, because the book takes this little curve and it goes into the rule of 72 and what is interest. And interest is just the ability, is just the money that's earned from letting somebody borrow your money, okay? That's really what it is. So if you set up a savings account at the bank, what would happen is the bank's actually using that money and they're investing it. So what do? They pay you a small amount of interest for keeping your money there and allowing them to invest it and make more money off of your money. So sometimes interest is going to work the other way. Let's say I want to buy my first house, and what do I have to do? I have to take out a loan. Well, now the bank's giving me money, so I have to pay them interest just for borrowing that money. It's important to remember, because if you're a business and you need to borrow a lot of money, you're going to be paying interest on that. So the next term that we have is compound interest. Compound interest is very important because it's going to make you really rich one day if you invest correctly. Compound interest is just interest simply on top of interest on top of interest. And that might seem a little bit funny, but let's say I had $100 and I'm going to put this into a bank account. And I expect to keep that money there for, let's say, the next 50 years. Well, what compound interest does is if I'm going to earn 2% on that $100, it means the next year I'm going to have $102. Okay? So normal interest, you take that $2 and the interest would build on $100 again. The next year you earn $2. The following year you earn $2. Compound interest, what happens is that first year you earn $2, now you have $102. So the next year you earn 2% on $102. So let's say now you have $104.50 in your bank account. The following year you gain 2% on $104.50. And then the following year, you gain interest on the $107.25, whatever it comes down to. And it doesn't seem like a lot to start, but over time, that interest builds on interest, builds on interest. And that's how people, by saving over a long period of time and letting compound interest builds up, become millionaires and are able to retire one day. So compound interest, if it's working for you, it's amazing. If it's working against you, let's say with credit card debts or anything else, well, then it's going to have that opposite effect. So compound interest. And then we kind of take another shift in the book and we look at this thing called GAAP. And GAAP's going to come up a lot. What does GAAP mean? It's generally accepted accounting principles. All right? Generally accepted accounting principles, it kind of sounds like a set of rules to me. And that's really what it is. It's very, very important that in accounting, we follow the same rules as we're reporting our income, our expenses, when we're creating those financial statements. What if when you guys did your personal net worth statement, I gave you those directions to just write down assets and liabilities, but you just started making up your own rules. And you said, you know what? Assets, I think I'm actually going to just double the amount that all those assets make. And I'm going to report it that way. Or you say, you know what, I'm going to report it where I write down the amount that I originally paid for that asset. Remember, we're talking about the shirt or the sweatshirt that was $30, but you're not going to get that later on. Well, then we have differing financial statements. And then after that, we can't really trust any of the information that's out there anymore. So it becomes a really tricky situation. GAAP is there to guide us when it comes to anything to do with accounting. And speaking of GAAP and things to guide us when we're creating reports and following rules is our first GAAP principle. And in the book, these are going to come up and there's going to be multiple principles and it's going to say it right in there, like what the principle is and how it pertains to accounting. And some of these might seem pretty silly because you go, well, yeah, that just makes sense. But they're a rule because in the past, other people have tried to do this. So let's look at the first GAAP principle, which is going to be unit of measurement. And what this really means is that as we are creating our accounting documents, we need to make sure that we are using the same unit of measurement over time. So that means one year you can't say we had $500 in sales and be upset about it, and then go the next year or the next month, say, you know what would sound a lot better? We had 10,851 pesos in sales, because that's the exact translation from $500. Now, it sounds a whole lot better, right? But we need all of our information to be clear and concise, and for different financial statements from different companies to look the same. So that's where this unit of measurement comes in and is one of the first GAAP principles that we look at in this class. The next one that we look at is the business entity. Now, this is where it gets a little bit tricky because we just talked about a proprietorship and talked about if our business does and we have a proprietorship and our business gets sued, there's a possibility that we lose some of our personal assets. Well, business entity is kind of tied in this, but it pretty much says that when it comes to financial documents, our person, okay, our own finances must be recorded completely separate from our businesses. Just because it's a proprietorship and there's a lot of liability for the owner of it does not mean that when we actually record anything with any kind of financial statements or transactions that we can put our own personal transactions on there. So that's the business entity concept. We do not want to mix our personal money along with the business's money. In a couple minutes, we're going to take a look at how the business owner invests money into his business, how to record that correctly. So those are a couple of the accounting terms in chapters 1.2, and I wanted to make sure that we cover those in a way that's kind of quick and concise and not just reading it in the book, but please make sure you go back there if you have any questions to kind of look at those vocab words and see if you need any clarification on it.